Hello, my dear future company secretaries. This is CH Hegde, your learning partner for financial management. First of all, can you please confirm that my voice is audible and the PPT or the material is visible? And meanwhile, if you are joining for the first time, please ensure you download the notes from the link given in the description below. Yes, everything is fine. Thank you. So, in the previous two sessions, we have discussed 6 chapters: basics, capital budgeting, capital structure, cost of capital, leverage, and dividend theories, and project finance to an extent. Today, we'll focus on the next chapter, next 3 chapters: first, working capital management, then, security analysis, and then, portfolio management. So, first of all, what is working capital management? In very simple words, it is the money required for day-to-day operations. Money required for day-to-day operations. To understand the working capital, we have to understand the working capital cycle. It's also called as a operating cycle. Working capital cycle. How does it work? You start a business with cash, capital, cash. And from the cash, you will purchase raw materials. And this raw material will be worked upon. That's called as a WIP, work in progress. And then when it is completed, it's called as finished goods. And once it is finished goods, it is sold to customer, and that is called as debtors, sold to customers, and then you collect the cash. This whole process is called as working capital cycle. So when you have a raw material, you will store it in go down or whatever in a storage facility in go down, and you will produce, you manufacture in factory, and finished goods that will be stored in warehouse or even factory outlet and all showrooms, and ultimately it is sold to customer, that is what is debtors. In meanwhile, yes, you will also have creditors. This whole process is called as working capital cycle. And for a business like hotel, restaurant, for them this whole process works fast. They purchase vegetables, tomatoes, onions in the morning, and they make the products and they sell, they get the cash. So within a day, they'll get the cash back. The sectors like, let's say, computer, it will not be sold within a day. They'll take few days to sell. So depending on the nature of the industry, working capital may be less, more, high, etc. It's also called as gestation period. Once you start a business, to start getting revenues, it will take longer period of time, especially for projects like infrastructure, road construction company, metro projects. So they require higher amount of working capital. That is because their gestation period is high. So nature of industry, policy of the organization, size of the business, all these things matter the working capital amounts. Okay, now how do we calculate this operating cycle? We have raw material days. Once you purchase, how many days you will keep it in raw material? That's called as raw material days. Raw material days. And that will be usually calculated as annual consumption. Annually, how much raw material you will consume multiplied by whatever the holding period, like 30 days 60 days like that, divided by 365, or you can divide by 360. Raw material holding days, raw material amounts, raw material amount. If it is raw material holding days, it will be slightly different. This is raw material amount estimation. So if I know the annual consumption, if I know the holding period, I'll be able to compute the raw material amount. Similarly, if I want raw material days, it will be calculated as annual consumption divided by 365 multiplied by whatever is the raw material amount, average stock of raw material. That will give you the raw material days. Annual consumption is for 365 days. Raw material amount is for how many days? That is to say, annual consumption is for 365 days. Raw material is for how many days? Just 1 second. Okay, I'm sorry. I just did one small thing, mistake. Sorry, this formula is slightly wronger. I'll give you one more formula. You should divide actually. This will be average stock of raw material, whole divided by annual consumption multiplied by 365. This is the basic formula I'm giving you for raw material. Similar thing applies for WAP, similar thing applies for finished goods, similar thing will apply for debtors. Okay, so raw material days is average stock of raw material by annual consumption of raw material. If it is finished goods, average stock of finished goods divided by annual cost of production. So accordingly, for WAP, finished goods, the debtors, the formula will change, but basic structure of the formula is this. Sometimes we may have to calculate the raw material days, and sometimes we may have to calculate the raw material amount like this. So similarly, if I want to do finished goods days, just an example, how I'm going to write. If I extend the same formula, numerator will be average stock of finished goods. Denominator will not be consumption of raw material. Denominator will be annual cost of production multiplied by 365. This will give you the number of days for how long the finished goods is kept with you before it is sold. Hope you understood. So if they ask you operating cycle, that one question also they can ask you. Operating cycle. How do you calculate operating cycle? If it is gross operating cycle, then it will be only current asset, which is raw material days plus WAP days plus finished goods days plus debtor days. Debtor days means how long you will wait to collect the money, how long you take to receive the money from customer. Debtors collection period, also called as average collection period. It is gross operating cycle. If it is net operating cycle, then same formula as above, but we'll also subtract payable days. So net operating cycle will be raw material days plus WAP days plus finished goods days plus debtor days, just like the gross operating cycle, minus creditor days minus payable days. And we also have policy, aggressive policy, defensive policy. So if you maintain more current assets, you are safe. That's called as defensive policy. If you keep less working capital, it's called as aggressive because you're taking more risk. And what's the basic formula of working capital? Working capital is given by current assets minus current liabilities. Very simple. Current assets minus current liabilities. So they can ask you the question in exam. Compute operating cycle in days, or they can ask you working capital in amount. So we estimate current assets, which include stock, raw material, finished goods, WIP, debtors, and current liability includes payable to creditors, payable to wages, and payable to overheads. And also we have two methods. One is called as the total cost approach. The other is called as the cash cost approach. Cash cost approach of working capital means when we take debtors, we ignore or we eliminate profits and depreciation. Why we eliminate profit and depreciation? Because it is not yet earned. It is not invested by us. For that reason, if it is cash cost approach, then debtors are calculated by subtracting profit. That value of debtors eliminating profit is called as cash cost approach of working capital. So broad things which are there in the working capital management topic. Now after that we should go for one by one. We have debtors management, inventory management, receivable management, and so on. That we'll look at it. Before that, let us do some basic problem on overall working capital. Theory is there. You can read through it. One more point I forgot to tell. This they can ask the question in exam. That is maximum permissible banking finance under Tandon Committee, MPBF. So if you go for a bank loan for cash credit, for overdraft, for working capital loan purpose, they will allow the loan as per this committee recommendation, where they say if you submit some working capital, there are three methods. Method 1, you have 25% from long-term resource. So if you say I want working capital of 100, they will tell you we'll pay you only balance 75%. 25% should be from your long-term source. Maybe your equity, maybe debenture, your source. But we will give short-term loan only for the balance amount. So 25% will be from long-term source is method 1. In method 2, 25% of current assets. In method 1, 25% of working capital comes from long-term source. Balance will be given by bank. In second method, 25% of current assets will be from long-term source. Balance will be given by bank as loan. And method 3, total current assets minus core current assets. There are some current assets which are always going to be there. Core current assets which will be there for a longer period of time. So from the total current assets, subtract core current assets, balance amount what will be there, that 25% you have to contribute by long-term source. That is method 3. And what is core current asset? In the exam they will give you, if at all they expect you. But what is most important is first method. More than second and third, from exam point of view, first method is important. So this is the overview of working capital chapter. We have to do one by one. In the sense, we have to understand about individual inventory management, receivable management, and cash management, and so on. First, let us take some basic problems. If you have any doubts in the basics, what we discussed so far, you can ask. I'll wait for 2 minutes. Okay, I'll go further. Let's do problems. Net working capital is equal to, that is I just told you, working capital, net working capital, both are same. That is equal to current assets minus current liabilities, option B. Net operating cycle can be defined as sum of raw material WIP and finished goods conversion period, raw material WIP, finished goods and receivable conversion period, inventory plus receivable conversion period minus deferred period, none of the above. So inventory plus receivable conversion period minus deferred period minus payable days. So it is option C. That is basically inventory days includes raw material, WIP, finished goods, all of them. Inventory days plus receivable days minus deferred period minus payable days. Asset minus liability. That is net operating cycle. If it is gross operating cycle, maybe I'll go for option B, because I don't subtract the liability. In net operating cycle, I subtract liability. In gross operating cycle, I don't subtract liability. So option C here. What will be the operating cycle period if raw material are in store for 2 months, processing time is 2.5 months, finished goods remain in store for 15 days, debtors are allowed 60-day credit period from the suppliers of raw material is 1 month. Let me give the interpretation quickly. Raw material are in store for 2 months. The moment you purchase raw material, immediately you don't consume in the factory. You will make a store. It will be in go down for 2 months. That is raw material days. How long it is in the go down stores. Processing time. Once it enters the factory, immediately same day it will not become finished goods. Like assembly of cars, manufacturing of ships, it will not become immediately finished goods. You need some time. That's called as processing time. And finished goods remain in store for 15 days. So once it becomes finished goods, immediately it will not be sold. It will take some time before it is sold. That is finished goods days. Debtors are allowed 60-day credit, which means how long, how much time you take to collect the money from debtors, that is 60 days. And credit received from supplier, so how long you take to make the payment to raw material supplier to your creditor is 1 month. And operating cycle period is, operating cycle will be add all the asset minus liabilities. So raw material store for 2 months, processing time 2.5 months, 2.5. Goods will remain for 15 days, half a month. 15 days means half month, 0.5. Debtors 60 days. 60 days means 2 months. So plus 2. And credit received, that is going to be subtracted. So minus 1. How much you get? 2 plus 2.5 plus 0.5 plus 2 minus 1, and that is 6 months. 6 months. Calculate maximum permissible banking finance as per first method suggested by Tandon committee from the information given below. So how do you calculate? It is going to be current assets minus current liabilities minus 25% of current assets. That will come from long-term source, will not be provided by bank. So current assets, what and all we have? Finished goods 500, finished goods stock 500, receivables 150, debtors you can say 150, other current assets, we'll take all of them. Other current assets 150. Okay. Other current assets. We'll take all the assets. Other current assets 150. Current liability, creditors 150. That you subtract. Creditors you subtract. So I'm writing within brackets. Other current liabilities. Other current liabilities 50. Debenture don't subtract. Debenture don't subtract. Because debenture is not a current liability, it's a long-term liability. Debenture don't subtract, so add the current assets, add the current liability, so you get 800 current assets, and you get 200 current liability, and 25% of current assets means 25% of 800. So 200 you have to subtract. So 800 minus 200, 600 minus 200, that is 400. Option is not there. What's the mistake? Calculation. Just give me 1 second. Have I done any problem? Finished goods 500, receivables 150, and other current assets 150. So 300 plus 500, correct, 800. Creditors 150, other current liabilities 50. Oh, sorry. It's not 25% of current assets. I'm sorry. 25% of net current assets. Oh, not 800. I'm sorry. I told you wrongly. 20, that is 25% of current asset is method 2, not method 1. Method 2 will be 25% of current assets. Method 1 will be 25% of net current assets. 800 minus 200, net current assets 600. Of this 25% you take. So you get 150. So 25% of 600 is 150. So working capital as per MPBF, maximum permissible banking finance, MPBF is 150. Sorry, 450. So 450 is option D. So please calculate that and let me know if you have any doubt in that number calculation. How do you arrive at net current assets? 800 current assets, current liability 200, 800 minus 200, 600. Current asset minus current liability is net current assets. 800 minus 200. Explain the method once more. Okay. First method, what I just did now, I am going to subtract 25% of net current assets, like I did now. That will be sourced from long-term source. Banks will not provide. That is first method. Second method, 25% of current assets you subtract. So in this problem, if I have to follow a second method, then it will be 25% of 800. 25% of current assets. That I should subtract. Balance, the bank will give loan. MPBF. If it is under third method, we have to subtract current assets minus core current assets. Net amount what is there, that 25% you subtract, the balance amount what you get is MPBF. So first method, 25% of current asset is subtracted. Second method, first method, 25% of net current asset is subtracted. Second method, 25% of current asset is subtracted. Third method, 25% of current assets minus core current asset, that amount is subtracted. The remaining whatever you get is MPBF under three different methods. Okay, I hope it is done. Okay, next we have EOQ and all. Okay, before that, Now let me explain about individual components. Components of working capital. Components of working capital. Mainly, what are the components we have? We will have cash, we will have inventory, and we will have debtors, and we will have creditors. We will have creditors. So in cash management, what you should know is how to maintain cash. Cash balance, how do you calculate? How much cash balance to maintain? Cash balance. For that, we follow something called as William J or William Baumol model. William J. Baumol model. William J. Baumol model. How much cash balance? Cash balance to be maintained. He has given you a formula 2AB by C. And inventory also. How much should be inventory levels? How much should be inventory levels? And of them, most important inventory level is EOQ, economic order quantity. And the formula is same, 2AB by C. So cash balance, inventory balance, same formula. So what is A? What is B? What is C? I'll explain. I'll give the full form, don't worry. Debtors is whether to give credit or not. Whether to give credit or not. That is debtors problem, and creditors management problem will be, if you make the payment early, what is it called as? You get some discount. It's called as cash discount. So creditors problem will be whether to accept cash discount or not. So I'm just telling you what are the kind of problems that you can expect. So in cash component, how much cash to be maintained? We are going to use this balance 2AB by C. Inventory level, how much for inventory to be maintained? We call it as EOQ, economic order quantity. And formula is 2AB by C. I'll tell the full form. Debtors, whether to give credit or not, whether to give 30-day period or 60-day period. That is going to be your credit policy. And creditors, what kind of problem you can expect? Whether to accept cash discount or not. If you accept cash discount, you pay immediately. If you don't accept cash discount, you can make the payment after some days. So, depending on this, let me give you the explanation. Okay, now coming to cash balance. Okay, what is the full form? A stands for, here in case of cash balance, annual cash requirement. Annually, how much cash do you spend? How much cash you keep it in hand annually, total. That is A. And B stands for cost per transfer. Cost per transfer. In every time you might maintain two accounts, one regular bank account, one petty cash account. Petty cash will be for cash expenses. So from the bank account, you transfer to petty cash. Some transferring fees will be there, bank charges, and many other things. So that is cost per transfer, that is B. And C stands for opportunity cost. Per 1 rupee. Opportunity cost. What is opportunity cost? I have 1 lakh rupees. Instead of keeping bank account, had I invested elsewhere, I would have generated 5%, 6% return. So how much I would have generated is called as opportunity cost. But don't worry about interpretation. In the exam, they'll give you all these things. Don't worry. Similarly, we have for inventory. What will be for inventory? EOQ full form, economic order quantity. We have A stands for annual consumption of raw material. Annual consumption of raw material. B stands for buying order or order, cost per order. Cost per order. Buying cost. It's called as buying cost. Cost per order. Also called as ordering cost. And C stands for carrying cost. Carrying cost per unit per annum. Carrying cost per unit per annum. Now, in this context, I would like to discuss a little bit more. Formula is only that 2AB by C, 2AB by C. Very similar. A for annual consumption, B for cost per order, cost per transfer, and C for opportunity cost, and here C for carrying cost per unit per annum. But I would like to spend few minutes. I know it might be costing subject, but I would like to spend a couple of minutes on what is this ordering cost and what is this buying cost. Now, before I answer, if I ask you a question, can you tell me, as a businessman, if I keep more inventory, more stock, is it good? Or if I keep less stock, it is good? Can you answer? Is more inventory good or less inventory good? So some people are telling less inventory is good. Some people are telling more inventory is good. Okay. Now let me explain what will happen if you maintain less inventory and what will happen if you maintain more inventory. So I'll give two columns. Less inventory, less stock, and more inventory. Now, let me talk about buying cost, ordering cost. It's called as ordering cost. What is ordering cost? How many times you place an order? For example, for your home, you require ration, rice, sugar, and all, right? Imagine every day you purchase. Every day you purchase, 30 days you go to shop and you purchase, you go to shop and you buy, you go to shop and you buy. What will happen? Ordering cost will increase. You maintain less inventory. You don't have to store anyways. So when you have less inventory, you have to go more number of orders. So more orders. More orders. Therefore, you will incur more cost, more ordering cost, more orders. So more ordering cost. You are not keeping less in, you're not keeping inventory much. You're every day you're buying because you don't have to maintain. Every day go and buy. It's also called just in time. But what's the problem? You have to go for more number of times. So more number of times means as you keep more inventory, or I'll get other way around, less inventory or more ordering quantity. Less inventory also means more ordering quantity because you're keeping less. So you're buying more number of times. Less inventory. Okay, let's keep less inventory. So less inventory means more orders, so more ordering cost. But what will happen to carrying cost? So what is carrying cost? Storage cost, insurance, holdage, your capital is blocked. Rent, go down rent. Less inventory, no. Less inventory means you save carrying cost. So less inventory, so less holding, less stock, less block, less holding means less carrying cost. Okay, now if you purchase more inventory, For entire month, whatever rice required, you purchase on day one itself. So you go to the store only once. So if you purchase more inventory, less orders. And less orders means you will have less ordering cost. And if you purchase more inventory, you have to store more. So more holding cost, and therefore more carrying cost. More carrying cost. Also think practically, my dear friends. Let's say you have a gobi manchuri shop. You have a gobi manchuri shop. Now, if you tell, I keep less inventory, if more number of customer comes, what do you tell them? Oh, wait, I'll have to go to market, buy gobi, I have to mix and then give it to you. Customer will go to some other shop. First of all, people don't have patience. You lose customer if you maintain less inventory. If you maintain more inventory, customer don't come. Whatever inventory you will have will be a wastage. I hope you're able to understand. In practical life, we always want to maintain a balanced inventory and ordering quantity. How much order you have to make such a way that you maintain equal cost. So what is the ordering quantity? What is the ordering quantity? Such a way that the ordering cost is equal to carrying cost. You don't maintain less inventory, you don't maintain more inventory. You keep a perfect balance where ordering cost and carrying cost both are equal. That ordering quantity where cost is least. You understand, right? If I purchase more, ordering cost will be less, carrying cost will be more. If I purchase less at a time, then ordering cost will be more, carrying cost will be less. So one more, one less. I want a lowest cost possible. That will happen when my ordering cost and carrying cost both are exactly equal. That is the minimum point, minimum cost. That minimum cost is called as EOQ, economic order quantity, economic lowest cost. Order quantity, how much quantity to be ordered. The same logic holds good for cash balance as well. Hope you understood. We'll apply. They can ask you theory questions, so I explain these things. Now let's apply in a problem. Determine the economic order quantity from the following figures. Annual requirement of inventory 1 lakh, cost per unit other than ordering cost 20, carrying costs are likely to be 10% per year, cost of placing the order 1000 per order. Okay, what is the formula for EOQ? Let's write down. EOQ, economic order quantity, is 2AB by C square root. What is A? Annual consumption, how much? That is 1 lakh, right? That is A. Annual consumption. What is B? Ordering cost. Cost of placing the order, 1000 per order. This is B. And sometime be careful. This is annual requirement. They will tell you per month. You have to multiply it by 12. Make it annual for inventory annual requirement. Don't forget that. Okay. And what about C? Carrying cost 10% per year. 10% of what? 10% on purchase price. So C, carrying cost 10% of purchase price, 10% of 20, that is 2 rupees. So we have got A, 1 lakh units, B, rupees 1000, and C, which is 2 rupees. Substituting the formula, 2 into annual requirement 1 lakh into B, B is 1000, divided by C, that is 2 rupees. And then take a square root. So how much you get? 2 into 1 lakh into 1000 divided by 2 square root. I think 10,000 units. 10,000 units. Now can you please tell me, this 10,000 units, is it per annum or per month? Option A, 10,000 units. Is it per annum or per month? Okay. It is not per annum. It is not per month. It is per order. This means every time you place an order, you will purchase a 10,000 units. Not per annum, per month. Every time you place an order, it is a per order, economic order quantity. The order quantity, how many quantity you order per order. Every time you place an order, what is the quantity? Such a way that the cost is lowest. Did you understand now? Okay. Now, if you understood, now can you calculate this for me? This problem is done. I'm going few steps further. Now, can you calculate for me in this problem? How many orders you are going to make in 1 year? If you understood this, my explanation, answer me this. How to solve square root? In the calculator, square root is there, press it. That's all I can tell. So calculate the number in the calculator, and square root button is there in the calculator, press it. If square root button not there, buy a calculator which has a square root button. Anyway, so if you understood my explanation earlier, please tell me in a year how many orders you are going to make. I will calculate, but I want to know whether you can understand. How many orders you are going to make? 10,000 units per order. One time you make 10,000 units in one order. But how many orders are you going to make? Question once again. Simple question. In a year, how many times you place an order? Okay. 28 order, 27.39 orders. Okay. Is it such a difficult question, is it? Okay, I'll ask you other way around. Can you tell me, in full year, how many quantity will you order? In full year, how many quantity you require? In full year, how many quantity you require? Full year, total, how many quantity you require? At least that is not a difficult question, I think. Annually, how many units you require? That also okay. I think people are getting 1 lakh, right? That question only has it. You don't have to calculate. 1 lakh. Okay. People are telling, I'm happy. 1 lakh you need for full year. And when you place an order, at a time, you purchase 10,000. Per order, you get 10,000. So how many orders you will place? How many times you go? In a year, I need totally 1 lakh. But if I have a visit once, I'll purchase 10,000 units. If I need 1 lakh, at a time, if I purchase 10,000, so how many times I should go? Now, I think you will be able to tell. I hope so. 10 orders, right? Okay. Now, let's write the formula. I hope you will be able to calculate. Number of orders is annual requirement by EOQ. If you want a formula, I'm giving you. Annual units, 1 lakh units. At a time, per order, you are placing 10,000. So you are placing 10 orders. And what is the cost per order? Cost per order is B. That is what? 1,000. So what will be the total ordering cost? Total ordering cost. I am making 10 orders. I am making 10 orders, and every time I place an order, I am incurring 10,000 rupees or 1,000 rupees. 1,000 rupees. Every time I place an order, I am incurring rupees 1,000, 1,000 per order. So what will be my total ordering cost? For one order, I pay 1,000. 10 orders, I will pay rupees 10,000 per annum. This is 10,000 for full year. For full year. At a time, I spend 1,000 rupees, but I'm placing 10 orders, just like the way they gave you. Or if you want direct formula, I'll give you. Direct formula is A by EOQ into B. That will give you the formula directly. A by EOQ into B. 10,000, 1 lakh by 10,000 into 1,000 rupees. You will get the number. Okay, that is carrying cost. They can ask you one more question. That is, what is this is ordering cost. They can ask you one more question. What is carrying cost per annum? Not per unit, but per annum, total, annually for full year. That is going to be calculated by average stock multiplied by C. C means carrying cost per unit per annum. Carrying cost per unit. What is going to be average stock? It's going to be half of EOQ. Why half of EOQ? That you don't worry. I'll tell you quickly. This is the unit. For example, what is EOQ? 10,000. 10,000 units I am purchasing. Now, when will I make next purchase? When this 10,000 becomes 0. Are you getting my point? I am purchasing 10,000 units. I use, I consume, I buy, I sell, I manufacture. This stock becomes 0. Then I go and buy again. Means my maximum stock is 10,000 units, minimum is 0, so average will be 0 plus 10,000 by 2. Anyway, even if you don't remember this logic, it's fine, but remember average stock is half of EOQ, or formula wise directly understand carrying cost is half of EOQ into carrying cost, and 1 by 2 into EOQ is 10,000. C is how much? 2 rupees. It's, yeah, C we calculated 2 rupees. So we get carrying cost per annum rupees 10,000. And please observe, what observe? I told you EOQ at that point your ordering costs will be equal to carrying cost. See, exactly equal to 10,000 rupees. In this problem they have not asked, they just asked EOQ, but they can ask you how many orders in a year. They can ask you what is annual ordering cost. They can ask you what is carrying cost and ordering cost. Some of this also they can ask. So I just calculated little bit beyond what is given in the problem. I hope you are able to understand. I'm not solving many problems. In the problem only, I'm trying to build all the concepts around it. So if you are preparing for exams also, try to have that mindset. When you read a problem, try to think little bit beyond what else could be asked. Because what is the difference between normal exam and a professional exam? 1 over how many balls? 6 balls. Wrong answer. Right answer in normal exam. Wrong answer in a professional exam. What is a professional answer? It is 1 ball delivered 6 times. Hope you understand. Everybody believe examination is like Kabban Park, where you can have a normal, pleasurable walk. Initially, it looks like that. It's not a Kabban Park. It is Jurassic Park. Easy to enter, difficult to exit. Any professional exam for that matter. Anyway, I hope you are able to get this one. I will come back. Yeah. Okay, this is the problem on inventory EOQ. A similar problem can be asked on cash balance also. Same logic applies. On debtors, they have not asked in the last few exams, so I could not get a direct question. But I will give you some illustrative number. I'll explain. In debtors management, receivable management, what question can be asked? Okay. Okay, let me explain now with respect to debtors management, the receivable decision or receivable management part. Receivable management. Okay, I'll give you some figures, some data points. You also write down. Then we'll analyze. Present sales is, let's say, 10 lakhs rupees. Gross profit or PV ratio. You know what is PV ratio or contribution ratio? I'll say contribution ratio is 20%. Means gross profit. Contribution ratio you treat very similar to gross profit. 20% gross profit. Present credit policy is 30 days. Present credit policy 30 days. Uh, Companies are proposed credit policy. Proposed credit policy is, let's say, 45 days. Proposed credit policy 45 days. Now, can you please tell me first? Can you please tell me first? If you give more time to make the payment, what will happen to your revenue? What will happen to sales? In the sense, if you give more time, your sales will increase or sales will decrease. I'm not talking about profitability. I'm talking about sales. If you give more time, instead of 30 days, if I give you 45 days, what will happen to your sales? What will happen to your number of customers? Oh, sales will decrease. Very good. If you give more time, sales will decrease. So number of customer will not come to you, is it? So you tell, instead of paying me 30 days, you pay me after 45 days. So customers say, oh, why are you giving me more time? Oh, I will not come to you, is it? Please apply some common sense and answer. If time is given more, what will happen to your sales? I'm not asking your profit. I'm asking your number of units sold. What will happen to customer base? I hope you have this much of common sense. If you give more time, what will happen to the sales? What will happen to number of customer? What will happen to number of units sold? If you give more time, sales will increase. I mean, more number of customer will come or less number of customer will come if you give more time. I'm getting an answer. Sales will decrease. I really don't know. If you are a businessman, how are you going to run the business? If you give more time, sales will decrease, is it? Instead of giving 30-day time, I am telling 45 days time. You are getting more time. Anyway, so if you are telling sales will decrease, I can only say God bless you. Please work on your common sense little bit is what I can say. I'm really shocked. Okay, if you give more time, 30 days, 45 days, 60 days, 90 days, more number of customers will come, sales will increase. Okay, I think I don't want to ask many more questions. I get the shocking answer like this. I'll be awestruck where I don't know how to explain also afterwards. So I am not in a position to take shocks. I will take heart attacks like this. So I'm not asking question. I will only tell the straight away answer. Okay. Now, when more time is given, sales is expected to increase. Sales will increase. As per their estimation, sales increase by, let's say, 10%. Say 10%, and bad debt also will increase because when you give more time, uh, the people who will not pay also will come, bad customer also will come. So that is what happens. Bad debts will also increase. So sales will increase by 10%. Bad debts increase from 1% to 2%. And companies required rate of return, or they say opportunity cost is, let's say, 12%. 12%. And the question is, should the policy be accepted? Should the policy be accepted? This is actually a full-fledged problem. I don't know whether they can ask this full-fledged problem in exam, but one part can be asked. Like how much is increase in bad debts? How much is increase in profits? One part can be asked, so I would like to discuss that part. Okay, so we are going to do a cost benefit analysis. We are going to give cost benefit analysis. I'm very afraid to ask this question, but let's see if you can answer. Okay, now you tell the customer, pay me 2000 6 times, or you tell the customer, pay me 1000 12 times. Can you tell me in which case you will receive more? Customer will pay you rupees 2000 6 times in a year. 2000, 2000, 2000, 6 times in a year, that he will pay, or rupees 1000 12 times a year. 1000, 1000, 1000, 12 times. In which case you receive more? 2000 into 6, there you receive more, or 1000 into 12, there you receive more. Okay, anyway, I'll tell the answer myself because I'm not in a position to take much of shock. The answer is same because total is going to be 12,000 only, no? Whether you receive 2000 rupees 6 times a year or you receive 1000 rupees 12 times a year, in both the cases, you will receive 12,000 only. So, how many times you receive does not matter. But when you collect 1000 little bit early, but if you collect early, it means you can save opportunity cost. Anyway, let me explain that one. When I'm doing cost benefit analysis, I'll explain it. So we have two types of, one benefit and two cost. Benefit is incremental contribution or contribution. Contribution, it's a benefit, profit. And cost, we have two types of cost. One is bad debts is my cost. This you please focus carefully. Opportunity cost on debtors. Opportunity cost on debtors. Opportunity cost on debtors. What do you mean by that? If you receive the money today, or you tell the customer, pay me after 30 days, he will pay you the money. But in those 30 days, time value of money is there. You lost the time value of money. Means what? Had I invested elsewhere, I would have earned money. I'll explain in the context of this problem. See if you're able to understand. Earlier, what you're telling the customer, pay me after 30 days. Now you're telling your customer, pay me after 45 days. Now, for the one customer, you're giving him more time. He will pay you 15 days later. Have you lost anything? No, he will pay you full amount. But what is your loss? Because he is paying delayed payment in those 15 days, you lost the opportunity cost. Sir, what is the opportunity cost? Had I received the money earlier, I would have invested somewhere in a bank, in share, in bond, and for those 15 days, I would have earned interest. Or other way also I can understand. I have taken loan, I have taken overdraft and doing my business. You tell me you pay after 30 days. Now I am collecting after 45 days. So for 15 days period, I still have to pay my loan. I still have to pay my interest. I lose that. And that is what is this company's required rate of return or opportunity cost of 12% for that period. So how it is going to be calculated, I'll show it to you. So opportunity cost is calculated by debtors amounts, whatever is receivable amount, debtors multiplied by required rate, or debtors multiplied by the opportunity cost, whatever you call it. So we are going to do under two columns. Under 30 days, the present policy, 30 days present policy, what will be our uh, what will be our contribution, our sales, and if it is a 45 days, what will be our contribution. So sales is how much? Sales is 10 lakh and contribution ratio 20%. So 10 lakh into 20%, that is my gross profit, that is 10 lakh into 20%, 2 lakh. 10 lakh into 20%, 2 lakh. If you give 45 days, they said sales will increase by 10%. How much? 10 lakh plus 10%. 10 lakh plus 10%. Can I say 10 lakh on the 10% means 1 lakh? 10% means 1 lakh. So total sales becomes 11 lakh. So my sales will be 11 lakh. On that, my gross profit 20%, which is 2 lakh 20,000. Is my gross profit. One size increase the sales. Bad debts 1 to 2%. In the existing situation, bad debt is 1%. 1%, 10 lakh into 1%, 1,000. No, 10,000. And in this case, 11 lakh into 2%, 22,000. Okay, here is an interesting portion. Please observe carefully. What is the debtors amount in 30 days and debtors amount in 45 days? How do you calculate debtors amount? I had given you the formula earlier. Anyway, I'll tell you once more. Debtors amount is calculated by whatever is your annual sales multiplied by the credit period, credit term, credit period divided by 365 or 360. I'm assuming 1 year equal to 360 days. Assuming 1 year, 360 days. That is 30 days a month, 360 days. My assumption, in the exam they'll tell you what assumption to make. Okay, so what is my debtors here? Annual sales 10 lakh into credit term 30 days by 360. 83,333. And here annual sales 11 lakh and the credit term 45 days, 45 by 360. 1,37,500 is the new debtors. Okay. Sometimes in the problem they'll tell you follow cash cost approach. In that case, what will I do? On 83,333 debtors amount. Cash cost approach means I remove profit. What is my profit? 20%. Gross profit 20%. So I'll take balance 80%. Balance 80%. If I follow cash cost approach, anyway, here I'm not doing it. But if the problem tells you, you should subtract profit from this. Just keep it in mind. Okay. So what will be my opportunity cost? Debtor is 83,333 and required rate of return is 12%. Required rate of return is 12%. So 83,333 into 12%, 99,999, let's say 10,000. And here 1,37,500 into 12%, 16,500. Okay, so what is my profit? Overall profits? How do I calculate? I'll show it to you. My contribution was 2 lakh. This is my benefit. My contribution was 2 lakh. And bad debts 10,000 is expense. And opportunity cost 10,000 is the expense. So net amount 2 lakh minus 10,000 minus 10,000. This 2 lakh minus 10,000 minus 10,000, that is 1,80,000. And similarly here 2,20,000 2,20,000 minus 22,000 bad debts minus 16,500 opportunity cost. So what will be the profit coming to? 2,20,000 minus 22,000 minus 16,500, 1,81,500. Now there is a benefit now, incremental benefits 1,500. So what do we say? Benefit is there. So a proposed policy should be accepted. Proposed policy to be accepted. Proposed policy to be accepted. If it was lesser number, if it was given negative number, then we say proposed policy is not beneficial. So in the exam, they can ask you incremental benefits or only contribution or only bad debts or only opportunity cost. I don't know what they ask particularly. Anyway, I have done the full-fledged calculation. I hope you have taken down these calculations. Explain opportunity cost. It is formula of opportunity cost is debtor amount into required rate of return. And what is the concept behind opportunity cost? Debtor represents delay in receivables. You are taking time to collect. In that time, in that delay, you could have invested elsewhere and generated the profits. But because you're collecting late, you lost that opportunity. As the delay happens, you lose the opportunity of investing and making profit. and that is what is called as opportunity cost, and formula is very simple, debtors into required rate. Any other question? Okay, I'll go further. Okay, according to William J. Bummel model, economic order quantity model with respect to cash management. Oh, sorry, one more problem I left out. What do you understand by the term factoring with respect to management of accounts receivable? Use of accounts receivable as a prime collateral for secured loan, pledging of account receivable to a lender, outright sale of account receivable to a financial agency, encashing account receivable by giving cash discount. It is option C. Outright sale of account receivable to a financial agency. Factoring means outsourcing. Factoring means outsourcing. Means you have to collect from customers. Instead of you collecting, you sell it to factor. They are called as factors, specialized people. They will collect the money and give it to you, or they will pay you money in advance. So the process of outsourcing the collection work, in banks also will be there, recovery agents. They will have on the vehicles also, recovery vehicle, something like that. They are called as factors who are specialized in collection services. According to William J. Bummel model, economic order quantity with respect to cash management, optimum cash level is that level of sales where carrying costs are maximum and transactions are minimum. Carrying cost and transaction minimum, carrying cost and transaction cost are maximum, carrying cost are minimum, and transaction cost are maximum. Actually, they should be equal. Okay, fine. It should be as minimum as possible. Yes, it should be minimum because it should be equal and the lowest points. You know, right? What is EOQ? Economic order quantity where expense is minimum. So it is that the rated, they are equal, but they should be lowest as possible. Therefore, you should select option P. Carrying cost and transaction cost are minimum, lowest. They are the lowest. That's why it is called as optimum. Optimum means lowest. Next, credit term 4 by 20 net 90 means a cash discount of 0.4% will be granted, a discount of 20% will be granted, a net discount of 90% will be granted, 4% discount granted if customer pays in within 20 days. Otherwise, he make the payment in 90 days. The answer is option D. Option D. So 4 by 20, 4 by 20, net 90. This net 90 is normal credit period. Normal credit period. And this 4 is the cash discount. And this 20 is eligibility to get cash discount. 20 days to get cash discount. To get cash discount. Okay. Option D is the answer. But here I would like to add one more question and one more point regarding whether to accept cash discount or not, regarding creditors thing. In this problem, I don't know whether I want to ask the question because I keep getting shocking answer. But anyway, I'll try. Please consider me as a weak-hearted person and try to give a common sense, reasonable answer. In this question, please tell me. Normal credit period is 90 days. Normal credit period is 90 days. And if you make a payment in 20 days, you get the cash discount. So, how many days early you have to make the payment to get the cash discount? How many days early you have to make the payment? Or if you don't make the payment, how much more time, how much extra time you get to make the payments? It is 70 days. I hope you are able to understand. Hope you are able to understand. It is 70 days because you have to pay in 20 days rather than in 90 days. So they'll ask you a question like this: 4 by 20 net 90, and opportunity cost of capital, opportunity cost for the firm, opportunity cost of capital is let's say 24% per annum. Should the cash discount be accepted? Cash discount offer be accepted. They'll ask you a question like this: should the cash discount offer be accepted? Then what will you do? Okay, now with cash discount, with cash discount, how much you are going to save? You save 4% for 7 days. You're saving 4% for 70 days, not for 7 days, for 70 days. You're saving without cash discounts. Without cash discount, you can earn somewhere, you can invest elsewhere for 70 days. So without cash discount, the sum money, instead of paying to them, I can invest elsewhere. At what period? For 70 days. And you earn uh, how much? 24% for 70 days. But 24% per annum for 70 days, how much? So 24 into 70 by 360 or 365 also you can do. 24 into 70 by 360. You get 4.66. So where will you earn more? You can earn more without using cash discount, right? So we should say cash discount should not be used. If I use cash discount, I get immediate only 4% savings. I save 4% for 90 days. But if I don't use cash discount, the same money I can invest in my business for 70 days. I can invest elsewhere. I can generate 24% return for for 70 days means it comes to 4.66%. So if I use cash discount, I save 4%. If I don't use cash discount, I will earn 4.66%. So I should not use cash discount. I should make the payment after 90 days. If it was not 4.66, if it was 3.66, then we say no, cash discount will be more beneficial. This type of question you can expect in exam. Okay, I hope you are done. This is your working capital management chapter. Okay. Next chapter we have is security analysis. Security analysis. Basically about stock market. About stock market, I think you people know the better. Company secretaries, who knows better about companies than company secretaries? But anyway, let me give some basics of it. What do you mean by listing and all? You know it. So, as an investor in stock markets, you are having two kinds of objectives. In when you enter into stock market, you have broadly two objectives or two trading style. I will say trading styles. One as an investor, another as a trader. Investor means I invest for 5 years, 10 years, 15 years, 20 years. Warren Buffett, his majority of the investment, his wealth, 90% of his wealth is created after he's crossing age of 50 years, long term. That is investor. Investor is long term. And trader who buys today, sell tomorrow, or buys today, sell after 6 months, or after 3 months, or buy today, sell today itself, intraday, who do derivatives, options, future. They are called as traders, and they are doing short term trading, short term investment. And with respect to overall objective, of course, overall objective, I mean, these short term people are also called as speculators. Why speculators? Because one person's profit, other person's loss. Short term, no. Today itself I buy, today itself I sell. So my profit is loss for another person. Every buyer has to be a seller. A seller has to be a buyer. I mean, if buyer seller is not there, the order will not take place. And objective is, of course, always to returns, maximize returns and minimize risk. Minimize risk. And how do you calculate returns? Returns, we don't know the future. How to calculate the returns? We take the past historical average. Historical average returns. Average. And statistically, how do I write average? X bar. X bar. X represents 1 year return, second year return, third year return. If I take an average, that's called as average return. X bar. And whereas risk is measured by standard deviation. Risk is measured by standard deviation, sigma. So standard deviation, they will not ask you to calculate an exam and all, don't worry. But if you just understand, standard deviation represents risk. Okay, we have two types of analysis. We have two types of analysis. One is called as fundamental analysis. Fundamental analysis. And another one is called as technical analysis. Technical analysis. Fundamental means looking into the company aspect. Oh, Infosys, strong management, no loan, profitability is good. They have got a history. They're in the company for many years. Oh, Tata's a very strong company. They have got a good promoter. Their ethics are good. Their products are good. So this is fundamental analysis. Focus on value, fundamental values of company. Valuation. Valuation. I'll just say value. So here we do like economy analysis, industry analysis, and company analysis. We look at the management, we look at the product, we look at the ratio, or we look at the future. Oh, we are now moving away from oil, petroleum. We are more in the future is all about electric vehicles. So, okay, let's invest in companies who produce electric vehicles. These are all fundamental valuation. Economy analysis, industry analysis, company analysis. Technical analysis means charts, graphs, patterns, charts, patterns, graphs. They are called as technical analysis. And to be specific, we have line charts and bar. More importantly, we have candlestick chart. That's a very important chart. And what is the fundamental assumption of technical analysis? History repeats. See, in the month of June, July, August, we receive rains. How do you know? Previous year it happened like this. So it is likely to happen the next year. So by looking at the charts, by looking at the patterns, we identify support zone, resistance, trend line, neckline, head and shoulder pattern, flag pattern, double top, double bottom, relative strength index, so many charts, indicators, moving average, they are called as technical analysis. So technical analysis purely focus on price or maybe value or volume. They don't worry whether company is having good management, bad management, they are taking loan, not taking loan, are they making profits? No, we only look at charts, patterns, that is technical analysis. And one important point you have to understand is candlestick chart. Candlestick chart means in a day there are four prices: open price, close price, high price, and low price. All these things are represented in a candle like this. This is the lowest price of the day, L, and this is highest price of the day. And open price may be this point, this one, and close price may be this one. This is OHLC, open high, low close. So if close price is below, that means that will be a red candle. The price has fallen down. If close price is above, that means it's going to be a green candle. The price have increased. If it is below, red candle, above, green candle. And the highest, it's called as wick. This point, no, highest point and lowest point, it's called as wick, W-I-C-K, wick. Candlestick chart. That you should be aware. Line chart, you know, it goes like this, share price, something like this. That's called as line chart. Okay, then where the price reaches and comes down, that's called as resistance. After falling, it gets some support and the prices are going up, that's called as support points. Some basics of security analysis. We also going to have more about portfolio management. How do you mix the shares? What is it called? That I will discuss it after this chapter. Any point you want me to explain here? Okay. Brief theory I've explained. You want me to explain candlestick charts? Candlestick. Candlestick chart represent 4 points: open price, close price, high price, low price. 4 price. The lowest point is low price. Highest point is high price. If it is green candle, that means open is below, close is above. The price have increased. That's called as green candle. Open below, high, open below, close above. Price have increased, so green candle. If the price has fallen in the day, open at a high price, ending the day at a low price, that means it has fallen, so open above, close below, that is going to be a red candle. So take a look at this one. I'm zooming in. Hope you can see this red candle below. The bottom red candle means what? That day price has fallen. Green candle here. If I can zoom in, yeah, I can zoom in. This looks better. You can see here. This is red candle. Today it started around 152. I mean, it started around 149 and it went up to 152. Started at a point below and increase in the day, that's called as green candle. And during the day, how much highest point it has fallen? It has reached up to 153. And during the day, it has fallen to the lowest point, small one line you can see, candlestick line wick, it's called as 149. That's what is called as candlestick chart. I hope you're able to understand candlestick chart. Green candle, price have increased in the day. Red candle, price have decreased in the day. Green candle, open is below, close is above. Green candle, red candle, open above, but price has fallen, so close below. It's called as green candle. During the day, the volatility, if you want to understand how it has moved, highest point, that's the wick at the top, lowest point, the line, wick at the bottom. Hope the candlestick chart is clear. Okay, good. Okay, fine. Which point we need to see while buying and selling? That is there is no rule. If somebody knows when to buy, when to sell, he would have become the king of the world. Nobody knows when exactly to buy, when exactly to sell. Everybody has opinions. Nobody knows whether share price will go up or share price will come down. This is just what happened in the past. We have various patterns. We call it as a double top. If it comes to resistance zone, we tell we sell. That I'm not trying to tell here. And I cannot even tell in so simple. And even if I tell, it may not happen tomorrow. These are all what happened in the past. So if the candlestick is big, it means, oh, today the volatility is high. If candlestick is small, or today volatility is small. That's all it will tell you. Higher the movement, higher will be the candle. Lower the movement, lower will be the candle. You can just say, oh, it is green, it is there like this. Oh, that means stock is going up strongly. If red is there, big means stock is falling down, strongly. So I cannot tell when to buy, when to sell. Nobody knows. There are some rules which I don't want to talk. They are all probability. There is no certainty in the stock market. Okay. Let's do one thing. Let's take a 5 minutes break. Let's take a break of 5 minutes and then we'll move towards the problem on this chapter and also portfolio management chapter. Let's take 10 minutes. 5:35 now. Let's meet at 5:45. Take a break of 10 minutes. Hmm. Hmm. Okay, let's move on to the questions now. Okay, so before taking investment decision, an investor makes a comparison of the available from each avenue and elements of dash involved in it. Before taking investment decision, investor makes a comparison of the returns available, comparison of the returns available from each of the avenue, returns from the fixed deposit, returns from stock, e-share, returns from mutual fund, returns from gold, return from land, and so on. Returns from available avenue and elements of dash involved in it, elements of risk involved in it. So it is return and risk, option C. In dash, future earning capacity is predicted with the help of accounting ratio, that is a company, with the help of accounting ratio, that is company analysis. Now, technical analysis, we look at the price and we look at the charts. In industry analysis, we look at the sector, competition, market, product, position assigning, monopoly. Economy analysis, we look at inflation, we look at GDP, political stability, economic stability. Those things are economic economic analysis. Company means company management, company's profitability, company taking loan or not, financial strength, balance sheet P&L. Those are called as company analysis. Dash focus more on past price movements from the firm's stock on the underlying determinants of future profitability, that is technical analysis. Technical analysis focus on price, it focus on charts, it focus on patterns. According to Dash theory, it is futile to engage in technical analysis. This is random walk theory. So as per random walk theory, technical analysis will not work, because technical analysis assume that the history repeats and can be predicted. Random walk theory tells you it cannot be predicted. It cannot be predicted. So both are opposite. Random walk theory is like walk of a random drunkard person. Walk of a random drunkard person. You cannot predict it. Whereas technical analysis says we can predict the charts, we can predict the patterns. So opposite nature, random walk theory. What is efficient market theory? Efficient market theory says market is efficient. Market reflects all information. Market's price reflects all information. That is the theory of efficient market hypothesis. What is this Dow Jones theory? Okay, what is Dow Jones theory? I'll explain in the next problem. Which of the following is most likely associated with primary trend, intermediary trend, and short-term trend? That is Dow theory. Now, Dow theory talks about primary trend, intermediate trend, and short-term trend. Primary trend, which means it may be 5 to 10 years, 5 to 10 years, long term, or 3 to 5 years, or let's say 3 to 10 years, long term. Intermediate term is called around within months. This is in months. So, trend, primary trend is in years. Intermediate trend is in months. Short-term trend is in days, within a day. Daily fluctuations also we see. So when you analyze the market movement into three categories. In the long term, what is happening? In the medium term, what is happening? In the short term, what is happening? Different time horizons. That is called as Dow theory. Bar chart is used to illustrate high price or low price opening and closing on a daily basis. So it is option C. For OHLC, open, high, low, close. High, low, opening, close on a daily basis. That is what is given by even candle chart. Bar chart also similar only. Candle will look like this. A bar chart they will do like this. So ultimately both will give the similar answer. So bar chart and candlestick both represent the same thing. Which of the following is not the basic principle of Dow theory? A bear market is established when the Dow Jones Industrial Average is moving down. There is usually a positive relationship between trade and volume of shares. Okay, let me explain. The answer is option A. I'll explain BCD. There is usually positive relationship between trend and volume. The answer is yes. Because if trend is high, the volume is also going to be high. If the volume is good, many people are buying. Volume is good, so you can understand the market is good. You understand, right? Restaurant, many people are there. Oh, food must be good. The stocks are purchased by many people. Volume is high. Stock must be good. The financial market has three distinct type of movements: primary trend, intermediate trend, short-term trend. Yes, that is also told by Dow Jones theory. I just told you now. The intermediate trend has duration of 3 weeks to 6 months. Yes, intermediate, weeks, months. Months I told you, weeks and months. That is intermediate. Yes, a bear market is established when Dow Jones is moving down. Just because price is down, it's not bear market. So option A is not told by Dow theory. So the option is A. Okay. Now I'll go for the next chapter and the last chapter, which is portfolio management. Portfolio management. Okay. Before we go to portfolio management, I would like to talk about two important points, basics. We have risk, we have return, and we will have risk. How do you calculate return? It's by taking average or return of security. We have three things. Return of security means individual share. Return of portfolio, and then we have return of market. That is RS, return of security, RP, return of portfolio, RM, return of market. Return of security, how do we calculate? We calculate by taking average return. To be specific, I do like this P1 minus P0 plus D1 by P0 into 100. What do you mean by P1? Price after year 1. What is P0? Price today. What is D1? Dividend after year 1. P price, D dividend. P1 price after year 1. P0 price today. That's how you get security return. You take an average. Portfolio return is going to be weighted average. How do you calculate the weighted average? No practical question this chapter. No security analysis. No practical questions. You'll have theory only, and whichever practical comes, it comes portfolio management only. It comes. So no practical in security analysis. Only theory you have. Okay. Now portfolio mean weighted average. What is weighted average? Portfolio return is given by R1 W1 return from first security W1 weight in first security. Then plus R2 W2 return in second security, weight in second security, and so on. Then we have RM market return, that is nothing but the index return. Index return. What is index? You heard of Sensex, Nifty, Dow Jones? They are called as index. They are called as market indicators, broad market indicators. They return. So when you calculate return from index, that is called as market return. Basically, they represent the market return as a whole. Okay, risk is measured by standard deviation. So this also we have three things: security, portfolio, and market. Security standard deviation, that is sigma S. Portfolio standard deviation, sigma P. And Markowitz we have, market we have sigma M. You don't have to calculate standard deviation. They'll give in the problem. You don't have to worry. But portfolio risk, we have to calculate. That formula I'm going to give it to you. But this is the basics. And three more measures I would like to compare. But before that, you please write down this chart and please confirm it is done. Then I'll explain three measures. Then I'll explain different portfolio theories we have. Okay, I hope you have taken down this one. Okay, I hope it is done. Okay, now you have to understand three important statistical measures. Let me explain. One is called as standard deviation. Other is called as beta, and other is called as correlation coefficient, that is measured by R. So standard deviation will tell you by how much a security is moving, by how much security moves from its average, from its average. What do you mean by this? If my average is 10, if standard deviation is 2, what do you mean by this? Oh, this security will give me 10% return, plus or minus 2%, plus 2 from its average, or minus 2 from its average. That's called as standard deviation. Deviation, how much it moves from its average. Whereas beta, please understand very importantly, beta measures sensitivity between markets and security, and beta of markets is always 1. Beta of market is always 1. Measures sensitivity. Sensitivity means what? If suppose beta is 2, it means if the stock market moves by 1%, if stock market moves by 1%, I mean index moves by 1%, Infosys moves by 2%, if beta of ITC is 0.5, means if market moves by 1%, ITC move by 0.5%. So one very important thumb rule I'll tell you, keep it in mind. From the markets to come to security, you multiplied by beta. From the suppose market is 10%, beta is 2. So what is security? Likely to move by 10 into 2, 20%. From the market to come to the beta, security, I mean to from the market to come to the security, beta is multiplied market return into beta will give you security return approximately. If I know market return 10%, if beta is 1.5, how much security will move? 10 into 1.5, 15%. Approximate shortcut, you remember. So what does beta measures? Movement of two people. That is beta. And how much it moves, that is given. Correlation is talking about the direction of two variables. A direction and degree of two variables. Two variables. And it lies between -1 to +1. Direction and degree of two variables. If one share price increase, other share price also increase, that means positive correlation. One share price decrease, other will increase, moving in opposite direction. That's called as negative correlation. Just remember R. You don't have to remember more than this. Even if you don't understand R, it's also fine. But what you have to understand is beta. This is very, very important measure you have to remember. Okay, hope you have taken down. Okay, I'll just give formula for risk of portfolio. Standard deviation of P, risk of portfolio. It's a square root of sigma 1 square W1 square plus sigma 2 square W2 square plus 2 sigma 1 sigma 2 W1 W2 multiplied by R. It's like a plus b whole square formula, my dear friends. Don't think too much. Don't worry about the formula. A square b square 2ab. A plus b whole square formula, don't you know? A square sigma 1 square W1 square. B square sigma 2 square W2 square. 2ab 2 sigma 1 sigma 2 W1 W2 into R. Into R. R correlation. And overall square root. What is sigma 1? Standard deviation of first security. Sigma 2, standard deviation of second security. Sigma means standard deviation. W1, W2, weights. Weight in first security, weight in second security. I really don't think they will ask you in this problem, in this examination, but just be aware of it. This formula, not really likely to be asked. You should know about the beta very well. But anyway, just remember this formula as well. Okay. Hope written down. Okay. Then I would like to talk about different portfolio theories we have. I would like to give a quick summary of it, portfolio theory. Okay. Portfolio theories or lines, whatever you can call. One, we have Markowitz portfolio theory, Markowitz. Then we have CAL, capital allocation line. CML, CAL, CML, both are similar. Let's write CML, capital market line. CML, capital market line. SML, security market line. It's also called as CAPM. I'll tell the full form, don't worry. Markowitz, CML, capital market line. SML, security market line. That's also called as CAPM, capital asset pricing model. And we have one more, that is characteristic line. Characteristic line. Characteristic line. Okay. Now Markowitz. I'm going to write 4 graphs. Markowitz, one graph. Capital market line, one graph. SML, security market line, one graph. And characteristic line, one graph. Okay. So Markowitz, the graph will be like this. So he explained standard deviation of portfolio on x-axis, return of portfolio on y-axis, RP. Capital market line, they measure standard deviation of portfolio and return of portfolio, and they write one line like this, that is RF. SML, they use beta, and you draw one line. That's what is SML, and here it is RF. And this is return only, return of portfolio. Characteristic line is very interesting. You also write one line. This is return of markets, RM. RM, return of market. Y-axis is return of security. Markowitz, the formula I just gave you now. That formula I gave you, standard deviation of P, square root of that big formula I gave you. That is the formula for Markowitz. In CML, I'll give the formula. SML, I'll give the formula. Characteristic line, I'll give the formula. But most important is CAPM. Capital market line, the return of portfolio is given by RF plus RM minus RF multiplied by RF, risk-free return. RM, market return, multiplied by sigma P, that is risk of portfolio, divided by sigma m. And capital market line we discussed earlier also. I'll write it here. Return of portfolio equals RF plus RM minus RF multiplied by beta. And characteristic line RS is given by A plus beta into RM. This much formula you remember sufficient. You don't have to think anything beyond in portfolio chapter. Four important theories: Markowitz, what the graph will represent; CML, capital market line, what the graph will tell you; SML, security market line or capital asset pricing model, CAPM, what the formula; characteristic line, what is the formula. And sometimes they'll ask you mathematical one. So in graph, please understand this starting point is called as intercept. Intercept. And by how much it increases, that's called as slope. So in the general equation, a plus bx, if I write, a is called as intercept and b is called as slope. That's a mathematical notation. I've seen in your examination question on these things. That's why I'm telling you this: intercept and slope. What is RS? RS is return of security. RM, return of market. RS, return of security. RF, risk-free security. R means return everywhere. S for security, P for portfolio, M for market. Heading only I gave you, right? Beginning only. Security return, portfolio return, market return. Three layers. RS, RP, RM. And RF also coming here, risk-free rate. This much if you know in portfolio management, sufficient. Basics I told you, three measures I told you, portfolio theories I told you. And three measures also will give you now, simple three measures. With that, you will be able to solve any problem in the portfolio chapter. Please take it down. And most important formula you have to know is CAPM. It will come in. It had come in the cost of capital chapter also. So this problem, this formula, please by heart. This you should know. RP equal to RF is risk return plus RM minus RF into beta. And RM minus RF is also called as market premium. This RM minus RF is also called as market risk premium or market premium. RM minus RF is also called as market premium, market risk premium. Until here, I just have to do two more small points regarding ratios and regarding types of risk. I should talk about it and then we can take up the problems. This much sufficient. Little bit extra also I'm telling you. So don't leave the chapters. At least this much you read. I'm more than confident you will get very good marks from portfolio chapter in exams. This knowledge itself will give you quite a few marks in exams. Then till here, intercept, be aware of it. Slope, be aware of it. I hope it is done. Okay. I'll just talk about types of risk. Then we can, and three ratios I should tell you. Types of risk. We have total risk. Then we have systematic risk. Then we have unsystematic risk. Total risk is calculated by standard deviation of security or portfolio, sigma s. Standard deviation of security. Systematic risk is calculated by beta. Unsystematic risk, residual risk. Residual. It's called as balancing figure, you can say. What is systematic risk? Macro factors. Macro factors. Macro factors. Corona problem. All stock prices crashed. Now, no more corona. All the stock prices will go up. Some war announced. All the stocks will come down. So it is general for everybody. Like a question paper difficult. Everybody question paper is difficult, right? Macro factors, inflation, interest rate, economy level, interest rate impact, inflation impact, GDP data. These are macro factors for which the stock price will fluctuate. Unsystematic risk is micro factors. Micro factors. Like there is a news, Maggie unfit for consumption, Nestle share price falls. Yes Bank, some problem, or Narayan Murthy resigns, Infosys share price falls. So management problem, product problem, financial leverage of a company, some joint venture, some news, product news. Tata Motor announce we are starting electric vehicles. Tata Motor share price goes up. Specific to a company, that's called as micro factors. It's called as unsystematic risk. It's also called as diversifiable risk. Diversifiable means it can be managed through diversification, investment in multiple stocks. Systematic risk cannot be avoided. It is in system. You can't avoid it. It is in system. It's called as non-diversifiable risk. Non-diversifiable risk. So beta, what does it measure? Beta represents a systematic risk. Standard deviation represents total risk. Again, we are not doing any calculations here. Just be aware of the concepts. That much is sufficient. I will just do ratios. Three ratios you should remember, and then I can go for problems. I hope you have done till here. I'll do three ratios. One is called as Sharp ratio, then trainer ratio, and then we have Jensen's alpha. Jensen's alpha. Okay, Sharp ratio is given by return of portfolio, risk-free security, RP, return of portfolio, RF, risk of security, by standard deviation of portfolio. This basically tells you portfolio return minus risk-free return is risk premium for 1 unit of total risk. Sigma means total. Whereas trainer ratio will tell you RP minus RF, numerator is same, denominator is beta of portfolio. So for 1 unit of systematic risk, Jensen's alpha is expected return or whatever, return of portfolio minus CAPM return. CAPM is cost. If you get more return than that, the excess is called as Jensen's alpha. And easy to remember, S for sharp, S for standard deviation. So denominator standard deviation, S for sharp, S for standard deviation, and trainer considers beta, otherwise numerator is same. Again, I tell you, this standard deviation represents total risk and beta represents systematic risk. Yes, this is all you want in portfolio management. This formula, try to read multiple times, recollect. I'm sure you'll be able to do well in exams. Any doubts in this one before I take up problems? Any concept I have to explain again? Okay, I'll go for problems then. Last two chapter, theory or practical sums. Security analysis is purely theory, but portfolio management we will have sums. We are going to do now. Portfolio management will have sums also. Security analysis is theory. Okay, let's do problems. The main aim of portfolio is to reduce dash by diversification. Main aim of portfolio is to, I think fill in the blanks is missed. Main aim of portfolio is to reduce risk by diversification. By investing in multiple stocks, we reduce risk. Don't put all the eggs in same basket. Don't put all the money in same pocket. Your friends will take away all the money. Don't invest all the money in same company. Invest in Infosys, invest in HDFC Bank, invest in Asian Paints, multiple stocks. You divide, distribute the risk. That is called as diversification. Capital asset pricing model account for. Now, can you tell me CAPM model uses which measure? Does it use a standard deviation? Does it use beta or does it use R? Which one does CAPM use? Please tell me. CAPM model uses which model? Which measure? Standard deviation, beta or correlation coefficient R? CAPM model, SML, both are same. Beta. And beta means what risk? I just now told you. I hope you remember and I hope you are not exceeding Gajini in forgetting things. Beta. And beta represents systematic risk. I hope you are able to follow. Beta represent systematic risk. Standard deviation represent total risk. Correct? CAPM uses beta. So systematic risk. Anubhav is planning to purchase a share that has a beta coefficient of 0.95. He estimates expected market return to be 12%, while T-bill means treasury bill, government bond is 7%. What rate should he expect and require the stock according to SML? Okay, beta coefficient 0.95, beta of security, expected market return, that is RM, market return. T-bill, treasury bill, government is considered to be risk-free, that is RF. RF we know, RM we know, beta we know, we have to compute SML, security market line, nothing but CAPM. CAPM and SML. CAPM is a formula. When you represent on the graph, it becomes a line. Got it? So CAPM is a formula, SML is a graph. So CAPM represented on the graph becomes SML, security market line. Only this formula you have to know. So RF, plus Rm minus Rf into beta. Rf is treasury bill 7 plus Rm minus Rf 12 minus 7 into beta 0.95, and beta is okay. This also you should remember, beta less than 1. Okay, I will write down that. First you complete, then we'll write down that. So 7 plus 5 into 0.95, 4.75 plus 7, 11.75. And sometimes they'll tell you Rm minus Rf is market premium. Sometimes they'll tell you market risk premium. Then don't do minus F. Rm minus Rf itself they would have given. So directly multiplied by beta. That is, don't subtract Rf if market premium is given. And one more point, just keep it in mind. Beta less than 1 means security is less risky than market. Because market risk, I told you, market risk is 1, beta of market is 1. So if beta is less than 1, that means my security is less risky than market. Beta is always a relative measure. It's a comparisonal number. Relative measure. Okay. So if beta is more than 1, beta is more than 1, that means security is more risky than market. Security is more risk than market. Beta is a sensitivity. Sensitive means comparison, relative measure, comparison. Beta always compares. Compares two things. What compares? Compares market with security. If beta is more than 1, my security is more risky than market. If beta less than 1, security is less risky than market. Beta equals to 1, then me and market are equally risky. Beta measures sensitivity. If one market moves, by how much security moves as a response, as a sensitivity, as a reaction. That reaction measurement is beta. Okay, next. Tunson Limited has beta of 0.8, market return 21.5, risk-free return 9.5, using CAPM, calculate appropriate required return of return. Can you please calculate this CAPM? Beta given 0.8, market return given RM, risk-free rate also given 9.5. So please calculate. I hope you are getting 19.1. 9.5 plus 21.5 minus 9.5 into 0.8. One more logic I will tell you, okay? If you are able to understand, good. If not, also good. Now, can you please tell me, beta is 0.8 means, please tell me, I just told you, security is less risky than market or more risky than markets. Beta is 0.8, less than 1. So, security is less risky than market or more risky than markets. Less risk, right? And less risk means return also will be less. You should know this rule. Higher risk, higher return. Lower risk, lower return. So my return should be lower than market return because my risk is less. And what is market return? 21.5, lower than 21.5. Yeah, option A is the only answer. So option A straight away you can do without even looking at the other options and without even calculating it. Anyway, so if you understand also good, if not also good, I'll go next. Intercept of security market line on y-axis is intercept. Intercept means so this line, this line, this is RF, right? And by how much it changes, that is beta. So RF is the starting point. This is called as intercept. So it is risk-free return. Beta of market portfolio is generally 1. Beta of market portfolio is 1. Market risk is 1. We are comparing with market. We are taking the base of beta as 1. That is the market. And one more thing, they might ask you, beta of 0, beta of risk-free security is 0. Beta of risk-free security 0, standard deviation of risk-free security also 0. Risk-free security, it cannot have risk. Standard deviation, total risk. Beta, systematic risk, no risk for risk-free security. So if at all they ask for risk-free security, no risk is there. So beta for risk-free security is 0. Standard deviation of risk-free security is 0. Okay. When a portfolio comprises investment in 3 shares, share A 40%, share B 25%, share C 35%, whose beta factors are 1.3, 1.6, 1.2 respectively, compute portfolio beta. Portfolio beta is nothing but weighted average. Now let me tell you what and all it means. Okay, let me write. Weighted average, portfolio beta. Here we have 3 securities. So W1 beta 1 plus W2 beta 2 plus W3 beta 3. 3. W1 beta 1, W2 beta 2, W3 beta 3. They are weighted average. So what is W? Weights 40%. That is W1. 25% W2. 35% W3. Then factors 1.3 beta factors beta 1, 1.6, beta 2, 1.2, beta 3. It's an average, weighted average, multiply. So 40% 0.4. 40% means 40 by 100, 0.4 into beta 1, 1.3 plus weight 2. That is 25%. 25% means 0.25 into beta 2, 1.6. W3, weight in 3, 35%, 0.35 into beta of 3, 1.2. So what and all you get? 0.4 into 1.3, 0.52, 0.25 into 1.6, 0.4, 0.35 into 1.2, 0.42. So 0.52 plus 0.4 plus 0.42, 1.34. 1.34 option. Okay. Now they can ask you portfolio return also. So if they ask you that, what would have happened? I would like to just add that one question. Just add that one question to the question. Just add. Just add it for this question number 7. Please add. If return of a or return of security are returns of security are 12 comma minus 5 and 30 respectively. Please add this to the question. If return of security of ABC 12 minus 5 30 respectively, then what is portfolio return? Portfolio return. What is portfolio return? They can ask you a question like this. Then what do you do? Portfolio return, weighted average. Portfolio return is given by W1 R1. Weight into return, just like weight into beta. Portfolio return, weighted average plus W2 R2 W3 R3. What is W1? Just like what we used here, same the weights only. That is 0.4, 0.25, 0.35, same weights. And returns, I gave you 12 minus 5, 30. So W1 0.4 into returns, I gave you here 12 plus W2, that is a 0.25 into R2, I gave you minus 5, be careful, minus 5 plus W3 0.35, R3, I gave you 30. So 0.4 into 12, 4.8, 0.25 into minus 5, minus 1.25, 0.35 into 30, 10.5. 4.8 minus 1.25 plus 10.5, 14.05. Okay, hope you've taken it down. Okay, I would like to have two more questions before I solve these two. So I would like to add the two more questions. 2 minutes break. We are ending the session. Why are you thinking of break? Okay, I would like to add two more questions. Then I will solve these two problems. Okay, add this question. Year 2015, 2016, 2017, 2018, and the price of, let's say, Infosys something. Let's say price of Infosys is 2000, 2200, 2500, 3000. And suppose if they ask you compute average return. Compute average return. How do you calculate average return? Okay. Now, how are you going to calculate? Return for 2015 you calculate. For 16 you calculate. 17 you calculate. 18 you calculate. And how do you calculate return of a security? You remember? I gave you formula. P1 current year price minus P0 previous year price by P0. And if you have dividend, I will add. In this problem, no dividend. Multiplied by 100. So year 2016, 2017, 2018. In that case, how do you calculate the return? I just told you 2200 is the current price minus 2000 previous price by 2000 previous price into 100. So how much percentage you get? 10%. Can you calculate similarly for 2017? Please calculate and tell me how much return you get. Just like the way I did, current year price minus previous year price by previous year price. You get 13.6363. So round it off. I think you get 13.64. If I round it off, 6369, round it off. And 2018, okay, I'll show you calculation. It is 2500 current price minus previous price 2200 by 2200. Current price 2500, previous price 2200. 2500 minus 2200 by 2200 into 100. Hope you get 13.64. Similarly, last year 3000 minus previous year price 2500 by 2500 into 100. 20%, zero point 0.2, and average, you take add all and take an average 10 plus 13.64 plus 20 divided by 3. Take an average. So 10 plus 13.64 plus 20 divided by 3. Average return comes to 14.5466. Round it off, 55. Average, add all the number, divide by 3. 3 returns only we got. So 10 plus 13.6 plus 20 divided by 3, 14.55. So sometimes probability also can be given. Returns multiplied by probability, you get on product column total. We had done like this in capital budgeting chapter. NPV multiplied by probability, we got expected NPV. Like that, returns also they can ask. Return 1, 2, 3, its probability multiplied. Product column you get. That total also you can do. You will get the answer. Okay. Anyway, they might ask you, so I just showed this calculation. Two questions are pending. I'll just complete and then we can conclude. And don't divide by 4. Huh? 4 prices are there. Returns are only 3. So don't divide by 4. Divide by 3 only. Make sure you don't do that mistake. Okay. So two questions are pending. Let me just complete it. Suppose two portfolios have same average return, same standard deviation, but portfolio A has a higher beta than portfolio B. According to sharp measure, the performance of portfolio A is same as the performance of portfolio B, better than the performance of portfolio B, is poorer than portfolio B, cannot be measured. Now, can you please tell me in the formula I gave you, a sharp measure, does it use beta or does it use standard deviation? Sharp measures use beta or sharp measures use standard deviation. Which measure does the sharp use? It uses standard deviation, right? Now, look at the formula. What is the formula for sharp? And shortcut also I told you. S for sharp, S for standard deviation. Sharp ratio, portfolio return minus risk-free rate divided by standard deviation. Same average return, same standard deviation. So, and it does not use beta at all. Higher beta, lower beta does not matter. It use standard deviation. It use returns. So for two stocks, standard deviation is same. Return also same. So performance also should be same. Beta different. Yes, beta makes difference in trainer ratio, not in sharp ratio. So it remains same. Option A. Okay, next one. ABC Limited has a capital investment of 400 crores. After tax operating income is 45 crores and the company has a cost of capital of 10%. Determine economic value added of the firm. EVA, economic value added. Okay. EVA is actual profits minus expected profits. Actual profit minus expected profit. Actual profit is calculated by operating income after tax. Operating income means EBIT. After tax means I do 1 minus T, 1 minus tax rate. But I don't have to worry about this. In this problem, operating tax operating income is already given by 45 crores. No need to do 1 minus T. But if they give EBIT, you do into 1 minus T. Explain once again Q8. Okay. Now, in question number 8, they are talking about sharp measure, sharp users, standard deviation. So if the two stocks has same standard deviation, their performance will be same, the ratio will be same. That's what I am selecting. Option A, having same standard deviation, therefore the ratio will be same. But beta different, that makes no difference. That does difference in trainer ratio because trainer uses beta. Sharp ratio, use standard deviation. Standard deviation is same. Returns are same. So ratio also must be same. So performance of A and B is same. Hope you are able to get question number 8. Okay. Now economic value added. Economic value added means how much is your expected profit and how much is your actual profit. Difference between what you expect and what you get. So if you expect I get 60 marks and you get 90 marks, you are happy. You expect 95 marks, you get 90, you are not happy. So life is also like that. It's all about expectations. If the expectation is exceeded, the economic value added is positive. Is my expected profit crossed? EVA will be positive. If EVA is negative, does not mean you are making loss. It just means expectations could not be met. So simple formula, actual profit minus expected profit. How do you calculate actual profit, that is EBIT into 1 minus T? That's called as net operating income after tax. And operating income only directly given 45 crores. After tax operating income only given. If they give EBIT, then I need after tax into 1 minus T. Don't subtract interest. I need operating income. Operating income is EBIT. And after tax means you should multiply it by 1 minus T. Expected profit means CE, capital employed, into WACC. CE, capital employed. WACC, weighted average cost of capital. Sir, how to calculate WACC? We learned the chapter, no, cost of capital. Cost of debt, cost of equity, cost of preference share multiplied by its weight. We have a product column and do the total. Same way, WACC. And capital employed means debt plus equity. Own funds plus borrowed funds. Loan taken, debenture. Debt plus equity, capital employed. Anyway, in the question they are directly given capital investment 400 crores. So no need to calculate separately. So 45 crore is the actual profit. Expected profit is 400 crore into 10%. 400 crore I have invested. 10% is the cost of capital. I am expecting 10% to generate on 400 crores. That means I should generate 40 crores. But how much I'm generating actually? 45 crores. I'm able to generate more. Therefore, that is 5 crores exceeding my expectation. That is called as economic value added. Option D. Economic value added. So EVA positive means our expectation is exceeded. EVA negative means our expectation is not met. Does not mean loss. Expectation is not met if EVA is negative. Here EVA is positive. That means profit has exceeded our expectation. How? We invested 400 crores. We are expecting 10%. That means we wanted 40 crores. But how much profit we achieved? 45 crores. 40 crores we are expecting. We achieved 45 crores. 5 crores excess. That is what is economic value added. Our expectation is crossed. EVA positive to the extent of 5 crores. Okay, so that completes there. Of course, chapter 9 is portfolio management. Chapter 10 practical case studies. That is not irrelevant from exam point of view much. So here we conclude that is last 3 days we started from the basics chapter, capital budgeting, capital structure, cost of capital, leverage, working capital, dividend theories, project finance, security analysis, and portfolio management. Quite a big syllabus. I tried to explain in a compact manner, and I took all the problems what we solved here are your previous exam questions. Each and every question I have taken from your institute website. I hope these questions are giving you some kind of confidence. What will be the situation if ER and AR are same? I don't know what is ER and AR. I think expected return, actual return. Okay, if it is equal, okay. If both are equal, that means our expectation is perfectly met. No value addition. You expected 90 marks, you got 90 marks. Your expectation not exceeded. Your expectation is not disappointed. It is exactly at your expectation. So we say no value addition. You got what you expected, but you have not got more. So no unhappiness and no happiness. No happiness, no unhappiness. Indifferent. Give us some tips to face exams. Uh, I can give you many tips, but ultimately you are the one who are going to write the exam. But I would like to give one small kind of motivation, maybe you can, if you apply. You know, a bird sits on a tree branch, but does the bird know that the branch will not break? Does the bird know about the tree? Does it have a confidence that the branch will not break? No. The bird sits on a tree. It's not the confidence on the branch, it has the confidence on its wings. So that even if the branch breaks, it can fly whenever it wants. So confidence is also like that. Confidence is not knowing all the answers, it is ability to face any questions. And how that ability to face any questions will come? That is the confidence you are having in your concepts, that is your wings. So focus on concept, the questions, solution, examination, things will come automatically. So only thing I can tell you is trust yourself. You are the only person who is going to face the exam. Nobody else will come with you. No friends, parents, teachers. So always have trust on yourself. Usually, one activity I do in class. I mean, in an online class, I cannot hear you. But anyway, I'll try to tell. See if you are able to answer my question. Just try to answer. I know I'm not listening to you, but try to answer. What is the color of tube light? White. I want quick answer, right? You don't have to write it. Just tell it to, just respond to yourself. Quick. What is the color of the tube light? White. What is the color of the snow? White. What is the color of the moon? White. What does cow drink? Milk. I'm sure many people would have thought milk. That is the power of time pressure in examination. So what is the most important point in exam if you ask me? One simplest thing, read the question carefully. Whichever subject it is, read carefully with the calm mind as much as possible and trust yourself. I'm sure you'll be able to write it well. That's the only tip I can give you. Trust yourself, read the questions carefully in exams. Okay, so I believe this sessions was useful. I don't know whether I am the best teacher or not, but definitely I can tell you I have given my best in these 3 days sessions to best of my knowledge and ability. Now it's up to you to give your best in examination. I've shared my mobile number and email ID in my material. It must be there. You can see at the and below page also it must be there. So you can contact me, message me, mail me, WhatsApp, Telegram, email, as you wish. I'll be more than happy to support you. So I'll just conclude with my last few sentences. With that, we will conclude. I usually tell in all my classes, this is my favorite sentence. Most people live as if they don't die, and most people die as if they have not lived at all. And only few people will be alive even after their death because of the work they do when they are alive and they made the difference to others' life. I wish you to be one of them, making the difference in others' life. See you soon at a professional level, at a uh, colleague level, at a professional level very soon. All the best for examination, and thank you for patient listening. Take care. Bye bye.